Okay, welcome everyone. My name is Ryan Staton. I'm one of the managing partners here at StatonWalsh. Today we're going to be going over our quarterly state of the markets, kind of a review of Q4 of 2025. Also, some things to look for and kind of a look ahead into 2026, some key considerations related to markets and some things that are on the horizon. Couple housekeeping items for those that are new or haven't listened in before. These are recorded sessions. They'll be redistributed after the fact. So if you can stick around with us the whole time or you can't, you have an opportunity to go back and watch them. We do have some time at the end for Q&A. We have a Q&A and chat box capability in the webinar. Feel free to use either. If you have a question along the way, you can ask it and we'll get to it when we have a moment. But thank you all for spending some time with us here. I'm going to get things started. And for those that are new, that aren't familiar with our presentations, I always like to start things off on a lighthearted note. Market-based topics can sometimes be a little heavy, but I usually like to start it off with a little, funny meme or something to kick things off to break the ice. So, 2025 was an interesting year for a lot of different reasons. One, we saw an emergence of different asset classes that had better performance than they have historically or really in the past decade or so. Gold and silver being one of them. So, from our old Austin Powers days of gold member there, I love gold and silver. We got a lot of questions about these two assets, specifically in 2025, primarily because they were getting talked about quite a bit. Anytime you turn on the news, especially financial news, they love to talk about, I like to call it like they talk about the hot hand, whoever's performing the best. And so these were things, and we're going to get into some of the reasons why last year that gold and silver were big. A big topic of conversation. But it's something that was interesting that we haven't seen in some time. And the performance of those assets well outpaced a lot of equity markets that traditionally had been much higher performing assets over the past decade at least. So let's just do a quick recap on what happened in Q4. On the left-hand side, we have domestic markets. So all the major indexes or indices, Dow Jones, S&P, NASDAQ, total return this is just for the fourth quarter of the year. Dow Jones was the leader on the domestic side at 4.03%. Um, NASDAQ coming in second and the close third, S&P, both in the mid to high twos range there. I think the big, not necessarily a surprise to us, but I think for most investors, the past decade, US and US growth especially has dominated. And so international markets took a big leap last year and actually outperformed US markets pretty substantially. And both on a quarter to quarter basis, but also over the course of the year. So fourth quarter of last year, you could see the MSCI World ex-US is pretty much the rest of the world, excluding the US. Emerging markets, smaller, under or less developed countries, and then the MSCI EAFE, think developed countries in Europe and parts of Asia, where developed economies, growing economies, and frankly, a lot of our trade partners here in the United States. So you can see there that as a whole, global investments outpaced domestic in the fourth quarter, and they also did so over the course of the year. And so if we take a look back at the year to date, closing out the year, the highest performing asset class was emerging markets. Second, the all world index, less US. US growth still had, 18.6% rate of return. So still a pretty good year for domestic stocks. S&P 500 was down or up just under 18%. So not a bad market year in general, but global definitely dominated in terms of overall performance and in many cases almost doubled the performance of US markets. And so that's been a big change. As you could see, the year to date, 1 month, 3 month, 6 month, you could see pretty much over the course of the past year, those two asset classes have dominated with the exception of US small in that 6 month window. But if we zoom out over the past decade, you could see the 10-year return, U.S. growth has been dominant. The international stage and world ex-US and emerging markets is about half of US over the past decade. And so there's a little bit of, market does this sometimes in terms of different asset classes shine in different periods of time. A couple years ago, we had commodities, which historically over the past decade had been essentially flat, had a really good year in the mix, and you could see that brought the long-term averages up pretty significantly. And so, I always argue this chart is and the changes that occur in this chart on a year-to-year basis are always the ultimate endorsement for diversification, especially global diversification. Now, had you been investing in domestic market or just domestic markets over the past 10 years, you would have done really well. Last year, you would have underperformed the global market pretty significantly as a result of that. And so, equities have still been dominant, just generally speaking, across the board, both domestic and internationally. Bonds and fixed income really have been, prior to 2022 low interest rate environment. Fixed income had its challenges. We had the spike in interest rates in 2022, and that pushed some performance. But as you could see, generally speaking, over the long term, the last 3 to 5 years, still modest returns in the fixed income space. So still a story for equities. Domestic equities still very attractive from a rate of return perspective last year, but again, global diversification was the big winner. So let's talk a little bit about some of the macroeconomic data and some of the things that are contributing to the market environment at the end of last year and also moving forward. Inflation was such a hot topic for a very long time. When I say very long, for a couple years straight, inflation was kind of the main centerpiece of a lot of conversations we were having, a lot of conversations related to the market. Now, as you could see from its peak in 2022 at right around 9%, it's come down. Right now, U.S. inflation rate is right around 2.71, with core inflation being about 2.66. So, not quite at the target range that the Federal Reserve has set, but pretty close. And this has had a big influence on interest rate policy. A combination of inflation data, economic data, U.S. growth, and ultimately a concern by many at the Federal Reserve that a sharp decline or cut in rates could have a negative effect, meaning it could increase inflation. We could see inflation jump back up. Their slow moving cutting of interest rates has, I would say, gone relatively well from an inflation perspective. The market has reacted positively for the most part, and the term that gets thrown around in media is soft landing. It's not a done deal yet, but I think that for many, they feel like the policy and some of the things that have happened in regards to one, spiking interest rates, but then bringing them back down, um, has been relatively successful all around. And now there are arguments to be made on whether people agree with that. Obviously, for folks that are buying homes or have made other major purchases, interest rates have not been favorable for those types of transactions. But generally speaking, rate of inflation has come down and stayed down as a result. The Consumer Price Index, just another measure of inflation. We see that at 324. Just going through earnings. So this is with inflation being higher, one of the challenges that we saw in 22 into 23 was that real wages, meaning inflation adjusted wages, were not keeping pace. So you can see a point on this bottom right-hand chart here where we were negative. Basically, we were going backwards. The amount of money, the rate of inflation, and the pay relative to that was not proportional. We're back to just about even, but you could see that the average hourly earnings in the U.S. as of today is $36.65 an hour. The U.S. real hourly wages, so adjusted for inflation, it's about $11.30. So big difference there. Um, the average year over year earnings, we're seeing adjustments, inflation adjustments, cost of living adjustments. People call it a lot of different things, but that was up about 3.74%. But again, when we adjust that number for the rate of inflation, you see a very modest 0.71. And so the good news, bad news, we are keeping pace with inflation, but um, wages historically do tend to do that, but we did have a short period of time where we fell behind. And so, one thing that I think gets talked about a lot, going back to the original conversation of inflation, is the rate of inflation that's published here and the real rate of inflation that we experience out there as consumers. And I think that ultimately is going to segue into conversations later about things like consumer sentiment and how we really feel about the markets because the economic data says one thing and the way we live and experience things is saying something different. Um, Looking really quick at employment, um, overall, U.S. unemployment still relatively low from a historical perspective, 4.4%. It has ticked up a little bit from its low of 3.4. Um, there has been a quite a bit of non-hiring going on, and so what I mean by that is there have been open positions that are just not being filled. That again goes back to that sentiment conversation. I think there is a general sense of uncertainty. Some employers have had positions open up that they choose not to fill. And so when you look at the data of unemployment, job openings, some of that coming down has been directly related to positions effectively just being eliminated, not because they're letting people go, but they're just not replacing or hiring. Some of that is technology related. I know that this AI has been a big topic of conversation in the workforce. What jobs will be continue to be necessary? What can be replaced by technology? I think it's an age-old question. It's a debate that's been going on for years. Even prior to AI, when you talk about automation and manufacturing and other areas. It is not a new conversation, but it is a new technology that we're talking about and what its capabilities are. And so, the other big thing that we've been focused on, and that generally is a point of focus, is labor force participation rate. So we still have not returned back to the same rate of labor force participation as we had pre-COVID. So there were a good bit of eligible working age employees who exited the workforce during COVID and never came back. That combined with a lot of openings, there's talent shortages in many industries, especially for things like skilled labor and construction is one big one that gets talked about quite a bit. Um, it's going to lead to some interesting decisions. And when we talk about things like wage growth, we're seeing at an industry level, some industries' wage growth is well outpacing what we just saw in that last chart, primarily just because of general competition. Now, because of that, it's more money out of pocket. That's also why we're seeing some positions not being filled as quickly or as easily. It's either a lack of talent, or a lack of available talent, I should say, or uncertainty about the future. And so when you look at other data on the right side of the screen, it's been relatively flat, meaning there hasn't been much change when we look at US layoffs. So companies aren't necessarily letting people go. There have been some bigger organizations that have been in the news, primarily technology industry, where there's been some large layoffs. But from an employment landscape perspective, there hasn't been a lot of we're letting people go because of uncertainty in the future. There's just a lack of replacement, which is a little bit different than what we're used to, and also makes it a little challenging in terms of predicting, um, using some of these economic indicators as future predictors of what's coming down the pike. So a lot of these on the screen, leading indicators, are ultimately going to be a measure of how markets will react. The market looks at leading economic indicators. It is a leading indicator itself, meaning that markets tend to try to predict the future and what they think is coming. And you'll hear terms like they price it in or it's baked in already. And a lot of that is relative to some of the indicators that are listed here. Now, the way to read this chart, just for anyone watching, you're going to go from right to left. Right is in the past, that's 2014. And then as we move to the left, that's into present day and Q4 2025. And so what you could see is on the right side of the chart, a mix of green, yellow, red. In the middle, we have a mix of green, yellow, red. And as we go farther to the left and we get into 2025, a lot less green and a lot more yellow and red. And so that a lot of these items are going to lead to market reactions and ultimately not necessarily market outcomes because it's hard to accurately predict that all the time. But when we look at what's going to happen in 2026, leading economic indicators are a little more neutral to negative than positive. So that doesn't mean that they're totally negative, but the big items on there, the deep red, so to speak, the big one is consumer sentiment. And I mentioned our feelings as people out there. What does the economic data tell us on paper, but what's our experience? And that's really the biggest, that can be a driver of economic activity ultimately. If consumers don't feel confident, they're uncertain about the future, they spend money differently, they choose to spend money differently, which affects economic activity. And so at the end of last year, the big question was, what was that going to look like during the holiday shopping season? There really wasn't much of a major change there, but nonetheless, consumer sentiment has been something that has been a point of focus. When we look at things like manufacturing activity, different surveys, treasury yields, things of that nature, um, all these kind of mesh together into one general consensus of um, cautious optimism or neutrality in predicting what's going to happen over the course of this year. And a lot of these indicators are US based. So as you saw last year, international markets uh, outperformed significantly US and domestic equities. And that very well may continue. It has continued at least at the start of this year. And that there's a very good possibility that that may continue. Partially because of sentiment, partially because of some uncertainty. There's some things floating out there. We'll talk about some of those factors here in a few moments, but there's a lot floating out there in the universe that I think just leads investors to want to be more cautious in 2026. So some of the good and the bad. Um, GDP has grown pretty steadily. So a measure of gross domestic product, a measure of economic activity and economic growth. We've had pretty steady growth quarter over quarter for US GDP. You could see the number in terms of real GDP. We've still been in a growth cycle with that. Those gray bars on there are representative of recessionary periods. But despite the threat of recession and a lot of indicators, things like inverted yield curves, which we'll talk about, and other items that were kind of swirling out there, we just have not seen a recession environment that was predicted. And so we've seen good GDP growth, we've seen economic growth. Now, the biggest challenge with that is we've still continued to accumulate a lot of debt as a country. And so US public debt as a percentage of GDP is over 100%. It's 118% currently, which I think is concerning for a large segment of folks. We've been in this deficit spending model for quite some time. Um, Debt is something that gets a ton of focus. I think too, there's a lot of focus on the geopolitical environment, who owns the debt. The reality is that a large percentage of debt in the United States is still owned domestically through pension funds and mutual funds and the Federal Reserve System, state and local governments, insurance companies. There's some intergovernmental debt. It's a mouthful, but basically debt that the government owes its own agencies. It says there's a little bit of shuffling and moving money around with how that is specifically structured. But a smaller portion of the debt is owned internationally, and so it's owned by other countries. There's been much conversation about how that will come into place as bargaining chip as we get into arguments with other folks around the world and what that looks like. The reality is that that the US dollar did weaken a little bit last year, but generally speaking, it does maintain its place despite some attempts to remove it as kind of the global currency. It still maintains its place as the global currency for trade, and so um, debt still an issue, one that has become more challenging to address, and more importantly, has led to consistent either partial or total government shutdowns over arguments of budgets and how we're spending, what we're borrowing, debt ceilings. That's been a frequent topic of conversation, which has been pretty disruptive, especially in this area where we're at in the Mid-Atlantic region. A heavy reliance for many employees in the state of Maryland, Virginia, and DC on federal government and shutting that down, how that slows in regional pockets, how that slows economic activity. So debt still continues to balloon, probably more and more every day. And it will be a big topic of conversation in 2026, especially when we talk about markets. When I mentioned earlier, talking about interest rates, mortgages specifically, we have seen mortgage rates come down, I think, more modestly than many would have hoped or predicted. But right now, the average 30-year mortgage rate is about 6.15%. The average 15 years is about 5.44. Historically speaking, that's not high. But in recent history, if you look back as far as 2010, even a couple years before that, prior to the financial crisis in 08, 09, these rates were relatively normal. I think we also have um, a very interesting environment of rapid increase in prices as well as rapid increase in rates, which makes it particularly challenging for folks trying to buy houses, and that shows in the data on the right side of the chart in terms of um, sales conditions, sentiment. Um, there have not been one big concern. I shouldn't say a big concern. It's a concern that gets brought up periodically by folks that are looking for things that are negative, unfortunately, is will all these people that have these higher rate mortgages and these higher priced homes be delinquent on their mortgage or not be able to pay? That just has not come to fruition. You could see that peak of that chart back post financial crisis. That was really the heyday is probably not the right word, but that was the peak of those mortgage delinquencies. We just really have not seen that trend. There's a slight uptick, but for folks that are 90 days or more delinquent, it makes up one less than 1% of mortgages that exist today. So no proverbial bubble there, nothing really to be overly concerned about on that front. Now, what's particularly interesting to me and has continued to be interesting is that we had this crossover at a point in late 2024 and last year where the cost of building a new home is cheaper than buying an existing home. And so that's relatively, it's it can be attributed to supply and demand, what's available. There have not been as many housing starts, meaning new builds and new communities. Some of that has to do with the shortage of land. Some of it has to just do with costs, where some home builders are holding off on building new communities. But the average national price of a new build is actually about $10,000, $12,000 cheaper or than an existing home. And so um, presents some challenges for home buyers, especially first-time home buyers, finding inventory. Existing home sales still significantly outpace. They're about 4 million on average, with 737,000 of new builds. So existing homes and the supply there, at least what's for sale, significantly dwarfs new builds. And new builds are cheaper, but harder to come by. So we're still in the phase coming out of the interest rate hike in 2022 and mortgage rate hikes during that same time that many folks, there's still a supply issue. There's a demand. We have a very well documented housing shortage. That's why I think we see in some cities, more apartment complexes going up. People need places to live. We don't have enough houses, and the houses that do become available still tend to be, not in all regions, but in many parts of the country, tend to be a little bit more competitive. So the combination of high price, high rate has certainly presented some challenges for home buyers, for folks that were anticipating moving or leaving an area, or first-time home buyers, and now those two are competing against one another while also not wanting to leave a low rate, low payment mortgage in their current home. Um, I think we still probably have a little bit of a ways to go in terms of rate reductions for more folks to want to move. But how fast we get there, it's hard to say. I think that it will be the norm. It has become the norm that an anticipated 5 to 6%, somewhere in the 5 to 6% range on a 30-year mortgage, will probably stick for a little while. And the likelihood of us getting back to the place of twos and threes is uh, nothing is impossible, but highly unlikely. So sales and consumer sentiment, retail sales year over year, we're still up in 2025. When we talk about consumer sentiment, however, we had slight growth there, but consumer sentiment has continued to come down. And so that measure, that index measure, averages about 84 and a half. Right now it's at a 52, almost 53. So um, there there is a cloud out there, I think, of just uncertainty, and it is really the general theme of this year of what is on the horizon, what do we need to be considering, and I'll throw myself in that box. We as consumers don't feel as confident or comfortable as we did, and there's a lot of different reasons why. I think there was a ton of stimulus, there was a ton of cash infused into the economy as a part of some of the COVID stimulus and COVID bills. Much of that excess, that surplus cash has dried up at this point. Combine that with high inflation, increased cost of living pretty much across the board in a lot of different segments. And I think you get to a place where consumers are feeling less comfortable with the amount they have saved, maybe have less of a surplus, or even in some cases, maybe starting to see situations where they're negative on a month-to-month cash flow basis. So, something to keep an eye on. I think that's ultimately the longer that number stays down, the more that will have a negative effect on economic activity. And that's really what tends to be the case when we look at long-term or historical precedent, I should say, with some of those metrics. Um, as far as interest rates, we see that just briefly go through this. We've seen sort of a normalization of the yield curve. So if you've heard this term before, if you've not, the term inverted yield curve got thrown around a lot in 2022 and 23. Really, that's just a measure of short-term interest rates being higher than long-term. And so when you're talking about treasuries or bonds or any kind of fixed income, typically the longer someone is borrowing money, the more interest you're going to pay on that. Now, what happened is we had a short-term spike in the Fed funds rate that led to 1 3 month, 6 month, 1 year treasuries paying more than a 30-year. That also changed investor behavior, more people looking at things like there was a big resurgence of I bonds, inflation adjusted bonds at the Treasury. Investors were able to get higher rates on high yield savings accounts, money markets. Basically, you were able to get a better interest rate without having to tie your money up on bonds that normally you would have had to buy on a 30-year note. So we're seeing some normalization to that. Now you could see on that right-hand chart, the 30-year rate's at about 4.84, while the 1 month is 3.74. There is still in that 1 to 6 month range. There is a little bit of inversion or inverted yield curve on that part of the tail. But generally speaking, we're starting to see that flatten out and start to return to a normal place. One of the scares with inverted yield curves is historically it had been an indication of a recession that was imminent. That didn't come to fruition, and we've made our way back to sort of a normalized yield curve. Um, Fed funds rate, 3.75%. There's still some talks about potential cutting, modest cutting. Their ultimate goal was to get to a target of 2.5%. Inflation is down around that level. And so the question becomes, will they chase that down, or will they still continue to be cautious? There's also some things on the horizon with the Fed chair, term limit or a term end, and I don't think it's been any secret that um, there's been some contention between the president and the Fed chair in recent months over a bunch of different things, but obviously a desire to bring rates down more quickly, and the Fed's desire to make sure that they don't put us back into a position where we have an overheating economy or spiking inflation like we did back in 2022. So. More to come on that, but the belle of the ball last year, gold and silver. So here's just a representation of the prices. Silver prices were up 102% last year. Gold price was 62 and change, and copper about 32%. So what tends to happen? We had a weakening dollar last year, some uncertainty in the markets and continued uncertainty in the markets. What happens sometimes, and what I should say sometimes, what traditionally happens is investors become more cognizant of that over time, and people start to move assets to places like commodities, gold, silver, and they view that potentially as a safe haven. Um, it's not always the case, but that tends to be a behavior that is repeated throughout history. And so you could see, relatively good, strong market environment. We saw a tiny spike post-COVID in 2020, leveling out again, and really saw that spike and that increase over the last year or so. And so over the past 10 years, that the price has increased about 282% on silver, 258% on gold. And so the natural question we get, should I be investing in this? Um, there are cases to be made for holding some investments. One of the biggest challenges when you hear about precious metals in particular is owning the asset directly versus owning the asset through an indirect investment. Think like a mutual fund, ETF, some kind of indirect exposure to that are not always the same. The hard asset itself, owning the physical gold or silver, has some inherent value. It also has some challenges, primarily in that once you have it, then you have to turn around and sell it. To convert that asset back into cash, you have to sell it, which means you have to have a willing buyer. Um, the the side effect of that is a lot of people aren't going to buy it at market value. And so we get into conversations, and I won't take this too far down a technical path, but we get into conversations about value on paper and actual intrinsic value, meaning like what could you actually get for it? What's the fair market value of something? And so it's exciting to talk about this stuff, I think, for a lot of people because it's something new or something that hasn't been relevant for a while. It probably will continue to be relevant. Precious metals tend to pop up. You're going to see more commercials about it. If you watch any financial news, especially, you'll start to see those have already heated up a little bit. My point of caution with that is always understanding the exchange of cash for an asset, especially physical gold or silver, that happens in order to go back it's not the same transaction as selling a traditional investment. So you just have to be mindful of that. Indirect exposure can work in some cases, but it's not always the same. You're not always getting the same results um, or the same experience from an investment rate of return perspective. So all that being said, not saying that that's necessarily a good or bad idea, but more importantly, educating on how you can participate in it. There's a couple different options. What, how, and when you decide to do that is really based on an individual circumstance. But I suspect that this will continue to get more and more attention as this year goes on, and I have no doubt that more people will continue to ask about these precious metals specifically as forms of investments. All right, so landing the plane here, and then we'll open it up to Q&A. Will markets continue to find headline risks? It's the million-dollar question. It's a question that we wrestle with quite a bit. there's been a lot of, when we say headline risk, there's a lot of headwinds or perceived headwinds out there in the market. The US economy just has continued to be resilient. The data tells us GDP is growing. We're still on an upward trajectory there. Um, things like tariffs were a concern. How would that affect inflation? That hasn't really come to fruition yet. And then beyond in this year and really until 2028 primarily, some elements of the One Beautiful Bill, the Big Beautiful Bill Act, OBBA, that's what that's referring to there. There will be some economic benefits related to, even in the short term, related to some policies in that bill. Now, there's a lot of those things that expire. So it's important to understand that much of that can and will be short term. That will run through the next election cycle, and then some of the things that expire, we'll have to see what the composition of Congress is, if those things continue, if certain things go away. But continued investment in AI is really important. Repatriating or creating more domestic operations for manufacturing has been a big focus as well. And so resilience still seems to be the theme. There's been all kinds of, we saw that leading economic indicator chart that indicate there's going to be some kind of headwind and, a lot of yellow and red on there. And even with that, those recession predictions have just not materialized. Doesn't mean that they won't at some point. I think if you say recession every year, eventually you'll be right. But for right now, the data says otherwise. And so, what do we need to monitor in 2026, and what's going to be important, especially when we talk about investments, investment portfolios, interest rates? I think interest rate volatility could be a thing. There have been some diverging views within the FOMC, which is effectively the committee that votes on some of the policy related to the Fed. You've heard Jerome Powell speak at length about wanting to be a little bit more cautious. There's been some internal, and we hear and see what we get from media, obviously, but it seems that there's been some internal infighting on that, or some disagreement on what the policy should be. But we are approaching the end of Jerome Powell's term as Fed chair. I know that the president has been pretty vocal about wanting to potentially replace him. Whether or not that comes to fruition, we'll see, but he does have a term ending this year. And so the question becomes, what will he do, or the FOMC do um, before then, if anything? And so interest rate volatility, what we mean by that is they could go up and they could go down. That will ultimately be based on economic data that they receive and what they decide. And so uh, I think the general sense is that they will continue to come down. How quickly? No one really knows. And I think there's a lot of things involved, a lot of moving parts and variables in that could affect what rate policy ends up being for the rest of this year. Um, we talked about the rise in U.S. debt and deficit. Yeah, I just talked about this, but the sharp rise in gold price and the weakening dollar, that's usually an indication that investors are becoming more aware of long-term risks to the U.S. economy. Um, the harsh reality is that most of our expense, our budget as a country, gets eaten up by interest payments on federal debt. And so our ability to make those interest payments is really it's what allowed this deficit spending to kind of continue. At some point, if the interest payments become the largest part of the budget and we don't have the revenue to support them, now we have a problem. So that's the big debate in Washington in regards to increasing debt ceiling. That's also the big debate about around interest rates, because what we're borrowing at directly influences those interest payments. There was a hope that they would be able to get rates would come down enough that they could refinance some of that debt at a lower rate. They missed the window on a couple of those tranches of treasuries. And so interest expense still looks like it's going to eat up a really large portion of the federal budget, which could become a problem in the future. So if rates continue to come down, that becomes less of an issue, but it's definitely something that you're going to have to keep an eye on, as the debate continues. right now in DC and as it will continue throughout this year. The other piece is elevated stock market valuations. So, a lot of indexes are near record highs. There is a historical concentration and a small number of large tech companies, especially on the domestic level. So that does provide a limited margin of safety. So if something materializes, unexpected risk materialize, that could create big swings or what we like to call like a whipsaw event, which is sharp downturn in a short period of time. Right now, tech continues to be volatile, but generally speaking, investment in AI, progression of that, still gives a pretty strong growth story to a lot of companies that are heavily investing in that space. But not all are moving in the same direction. And so when you think about investing in an index, you think about diversification, broad diversification, getting exposure to a lot of different companies. Right now, especially in the S&P 500, there's a very large concentration of that index to a small group of companies. And so that just creates some additional risk, some additional volatility, and makes a case for diversification just outside of a broad index, but also looking at other parts of the market and other parts of the world, specifically. So uh, valuations are going to continue to be important. Um, it will create some volatility, and so that cautious optimism that I talked about earlier on is really just based on the fact that there could be this could be a pretty volatile year, up and down. Um, could it continue? Will it continue the same way that it has the past few years? It's unlikely. Will markets continue to grow? It's certainly possible. It's also possible, depending on the outcomes of some of the events I mentioned earlier, that we could be going in the opposite direction. A few of those we won't really know until we get there. But generally speaking, the market has been viewing economic activity, economic data positively, and so the look into the future has been more on that plane of the cautious optimism that I mentioned. So I feel pretty comfortable saying modest growth is probably the way of the world this year, and that there will be periods of volatility just like there were last year. It goes without saying, and at the risk of sounding like a broken record, maintaining discipline and maintaining diversification is going to be the most important part of cycling through a market environment like I just described. So, um, a lot on the horizon, still some perceived headwinds. If none of those things materialize, we could be in a very similar position as we've been in years past. But I do think that. But this is a year for a little bit more caution when we look at some of the things that are out there. It also is a midterm election cycle as well, so that certainly will have an effect. We'll see that in the fall of if there is a change in Congress, or a flip where we get a basically a stalled government for the remaining 2 years of the second Trump term. So. All those things will be relevant, and they will especially be relevant as we look into the end of this year or the middle to end of this year and beyond. So, with that, I will turn it over to questions. Feel free to throw them out there. You can use the chat or the Q&A. Either works. Hopefully, I didn't put everyone to sleep. Kidding. Um, yeah. Well, if you'd like to stick around, I'll stick around. I'll hang out for a few more minutes. Happy to answer questions. If you like to get back to your day, give you a few minutes back and let you enjoy the rest of your Wednesday here. And we appreciate everyone's time. Thanks for dialing in. If you ever have any questions about this topic or any of the others that we talked about, feel free to reach out to me. You can reach out to us directly, and I'm happy to answer them on a one-on-one basis as well. We will send out the recording. So anyone who's on this call, and then we'll also send the link. So you'll get a reminder after, so you'll have an opportunity to watch it again. Thank you. Great question. Everyone, thank you. Enjoy the rest of your day.